Welcome to The Explainer. Today we're unpacking the global economic forecast for 2026. Now, on the surface, things look surprisingly good, but underneath it all, the world is walking a very, very fine line. And that quote, it just hits the nail on the head, doesn't it? It perfectly captures this huge paradox. The global economy is like an acrobat on a tightrope. It's moving forward, looks pretty balanced, but with every single step, the potential for a fall just gets higher and higher. So to really get our heads around this balancing act, here's what we're going to do. We'll start with that strong surface, then we'll look at the cracks forming underneath. After that, we'll dive into a new kind of inflation shock, talk about two massive game-changing forces, and finally, figure out how to stay on that narrow path forward. Okay, let's dive right in, starting with the view from above, which, honestly, against all odds, has been remarkably positive. I mean, think about everything that's been thrown at the global economy. Trade tensions, political drama, you name it. And yet, it's proven to be incredibly tough. Growth has held up, inflation has cooled down from those crazy peaks, and the markets have performed a lot better than most people were betting on. Now, here's where it gets really interesting. This data shows us where that growth is happening, and it's not one single unified story. You're seeing really strong expansion in places like Asia, fueled by tech and manufacturing. But then you look over at some of the advanced economies in Europe, and it's a completely different picture, much slower, almost stagnant. This growing gap, this divergence, is a major fault line with huge implications. So, you might be asking, if the surface looks so calm, why are we even talking about a tightrope? Well, it's because when you're up on that high wire and you dare to look down, that's when you start to see the cracks, the big ones, forming in the foundation. And the single biggest concern, the one that keeps economists up at night, is this absolute mountain of government debt. It is massive, and it just keeps growing. For years, this was kind of seen as a problem for the future, something to kick down the road. Well, guess what? The future is here. And markets are starting to treat this debt like a real constraint on what governments can actually do. And this number just perfectly illustrates the scale of the challenge. The US is on a path for its government debt to hit 130% of its entire yearly economic output. Now, this isn't just an abstract number on a spreadsheet, no way. It means higher borrowing costs for everyone, and it gives the government way less flexibility to respond to the next crisis. So debt is the big one, but it's not the only fault line. Inflation isn't falling at the same speed everywhere, which makes it super tricky for central banks to coordinate their moves. There's a real risk they make a mistake, right? Cut rates too fast, and boom, inflation comes roaring back. And all of this is happening in a world that is just becoming more and more fragmented, both politically and economically. Now let's zoom in on inflation for a second, because this is so important. The threat that we're looking at for 2026 is a fundamentally different beast from the price spikes we saw right after the pandemic. Remember that post-COVID inflation? That was a classic case of too much money chasing too few goods as the world reopened. But the potential inflation of 2026 is different. It's not about shipping containers stuck at sea. This is about politically driven tariffs creating new, maybe even permanent barriers to trade. And here's the crucial point. This isn't a temporary problem. A tariff isn't a bottleneck that you can just clear. It creates long-term uncertainty. It forces companies to delay investments and maybe reroute their entire supply chains. And all of that, well, it can lead to permanently higher costs and sustained inflation. Okay, so as we're walking this tightrope, there are these two powerful crosswinds that could either help us get to the other side or, well, blow us right off. And those two forces are artificial intelligence and politics. First up, you've got the AI revolution, and it is a revolution. Private investment into AI infrastructure has become one of the single biggest drivers of economic growth, particularly in the United States. The scale of this is just hard to overstate. An estimated $432 billion. This boom in building the picks and shovels of AI, we're talking data centers, servers, software, it's a seriously powerful positive force, propping up an economy that might otherwise be slowing down. Now, the other force is far more unpredictable. Across the globe, there is this growing political pressure on central banks. The very institutions that are supposed to keep inflation in check. They're being pressured to make decisions based on short-term political goals instead of long-term economic stability. And if you want to see exactly why this is so dangerous, just look at Turkey. Starting back in 2018, the government there pressured its central bank to lower interest rates even though inflation was already rising. The result? A complete loss of investor confidence, skyrocketing inflation, and a currency crisis. It's a textbook example of what can go wrong. And don't think for a second this is just a concern for emerging markets. The US Federal Reserve is facing intense political scrutiny, and with the Fed chair's term ending in May of 2026, there's this whole other layer of uncertainty about the future direction of the world's most important central bank. So, with this incredibly delicate balance, resilience on one side, huge risks on the other, how should businesses and investors even think about keeping their footing? This quote sums it up perfectly. There's a big mindset shift going on. The past few years felt like everyone was just reacting to one crisis after another. Now the focus is on building businesses and strategies that are durable enough to withstand whatever comes next. For investors, a lot of experts are suggesting what you could call a three-dimensional approach to diversification. It's not just about what you own anymore, it's also about diversifying where you own it, geographically, and the major long-term themes you're investing in, like AI or the energy transition. And that really brings us to the bottom line. The global economy is not in crisis, but it is in a really precarious position. That path forward is narrow. There are incredible opportunities for growth, but they're balanced against some really significant risks of a misstep. Ultimately, the line between resilience and fragility is so much thinner than it appears. And whether 2026 is remembered as a year of surprising strength or the year the tightrope finally snapped, well, that's not going to be a matter of luck. It's going to come down to the choices that policymakers make and the discipline of investors in the face of all this mounting pressure.